Hi, welcome to Money by Sunny. It's an uncomfortable reality that it's so hard for individual investors to watch their investments decline and their anxiety increase as they contemplate the impact on their investment portfolio. It's even more anxiety-inducing to think about making an investment decision that could subsequently prove to be a mistake. However, it's precisely when investment worries are the highest that you must remain most calm and focused on the principles of good investing. There are many common investment mistakes that individual investors make, and unfortunately for many, it's too late to learn the lessons of these missteps in a textbook. Instead, you must learn the lessons of history. By studying the major errors of past investors and markets, you may be able to avoid future disasters, and thus improve your chances of beating the market. Let's go through the 7 deadliest sins that all investors should avoid. Sin number 7. Trying to time the market. It's natural to want to trade. After all, you can only make money if you are invested in the market. But trying to pick market bottoms or tops is generally not a good idea for retail investors. Even professionals who attempt to time the market often find themselves on the wrong side of the trade when markets are rising, and on the wrong side of the clock when markets are falling. In fact, the difference between the performance of investors who trade frequently and the performance of investors who don't can be negligible, especially once you factor in risk and volatility. Furthermore, there's no proof that traders who rarely trade would have done better if they had been more frequent in their trading behavior. Perhaps investors who don't trade are better because they're able to stick with their long-term strategies. Additionally, trading costs money, as each trade may incur a fee or commission, or even interest or swap charges if you use leverage. So an investor may be sacrificing profit just for the psychological thrill of being in the market. But of course, this is not the main objective of investing or even trading. Let's remember that we should only be in the market to earn money, not to be entertained. For all these reasons, long-term investing should be your default position. If you feel an impulse to trade, see if you can fight it through several business days or even a full month, which is generally the length of time considered necessary to be confident a stock is a good or a bad investment. Sin number 6. Overlooking the impact of tax. It's easy to overlook tax consequences when investing, and this tends to be a particularly significant issue for individual investors who lack the advantages of tax-efficient funds, dividend reinvestment plans, and other tools available to institutional investors. There are a few factors that determine your tax bill on investments: the type of asset, where it's located, and how you hold the assets. On a domestic stock index fund, for example, U.S. investors pay 15 or 20% capital gains tax on profit. In Canada, however, typically half of capital gains don't incur any tax, and the other half is added to the individual's income and taxed at the income tax rate. In short, there's a lot of variance in terms of how your gains will be taxed according to where you live. So it's important to do some research ahead of actually triggering any investments. This is so that you can factor in taxes when calculating your potential returns. It's definitely worth taking some time to understand how taxes affect the net gains on your portfolio. This is particularly so when you are investing in potential higher return areas such as stocks. Sin number 5. Buying high-cost funds. Why do some investors succeed by investing in expensive funds while others fail? One reason is that the premium fees imposed by some funds may dwarf any advantage those funds may have over lower-cost alternatives. Many people have the impression that they need to buy high-cost mutual funds in order to make a good return on their investment. However, this is not always the case. It's like running uphill, both to invest and to earn a return. All other things being equal, a comparison of underlying investments, management quality, etc. The higher the cost of ownership of a fund, the smaller your return will tend to be. The good news is that it's easy to avoid this mistake. Just select low-cost index funds or exchange-traded funds as the foundation of your portfolio. Then you can be extra judicious and extra careful when it comes to the higher-priced funds by really scrutinizing each potential one very closely. to see if it meets your investment objectives. Sin number 4. Too many eggs in one basket. Another common mistake that investors make is to invest too heavily in funds or portfolios that are not sufficiently diversified. For example, some funds concentrate on a single industry, which can rise and fall dramatically with little regard for the performance of the overall stock market. Others put a large portion of their assets into the securities of a single company. This configuration can leave the fund exposed to a disproportionate amount of risk. By contrast, broad market index funds provide diversification right out of the box, since they track the performance of the vast majority of publicly traded companies, whether that's in the US or many other countries around the world. As you get more experience and gain a deeper understanding of the investment market, you can move some of your investments into more specialized funds if you have a strong view of the particular market or industry. But it's a mistake to start there if you're new to the world of investing. Sin number 3. Not having risk control in place. Many individual investors don't have well-thought-out risk control principles in place when they invest. This is one of the deadliest mistakes an individual investor can make because it allows fear to creep in and do damage to their portfolio in down markets. Fear is one of the greatest enemies of the investor. You definitely don't want to let emotions get the better of you when your portfolio starts seeing some turbulence. So it's vital to have a clear risk control strategy. This should ideally address 3 things: how much you're willing to risk on a single investment, how many investments you're willing to have in a single industry or sector, and how long you're willing to hold on to a non-performing investment. A good time to review these items is after a losing period such as a down market. And don't think that this is only for the big boys or the institutional investors either. In order to maximize gains and minimize losses, solid risk management should be a part of every investor's toolkit. Sin number 2. Holding too many stocks. Many investors choose to diversify their portfolios by holding a large number of stocks. And diversification is certainly a good practice to have, as we covered earlier in investment sin number 4. After all, if you own stocks of 50 companies, the reasoning is that it's hard for any single one to make a significant impact on your portfolio, unless of course they all drop at the same time. However, this can often lead to subpar performance, as diversifying just for the sake of it is not a winning strategy. Holding too many stocks can also result in a lack of focus, as you can easily be distracted by having to monitor too many things. Studies have shown that a portfolio of just 15 to 20 stocks is often just as diversified as a portfolio with dozens of stocks or even more. This is as long as you do your research and diversify into industries or sectors that are not correlated with each other. What this will allow you to do is to spend time on the most promising investments and consider ditching or reducing your positions in the underperformers. Sin number 1. Not doing enough research. Too many individual investors don't do enough research on the companies they might invest in or the asset they are considering. But doing proper research is one of the key elements of winning the investor game for several reasons. Firstly, even if an investment looks promising on the surface or comes recommended by friends or acquaintances, there could be hidden risks that you are not aware of. Secondly, even if an investment is considered low risk, it may not be the best possible use of your money. There could be other investments with higher returns and a similar level of risk. Finally, even if you are comfortable with the risks of an investment, you may not be comfortable with the company or management team behind it. Sure, research does take time, but it's your hard-earned money that you are investing, so it's vital to do the homework. Of course, even the most well-researched investments sometimes lose money, but getting the right research in will at least help give you the best possible chance of success. By understanding and avoiding these 7 common investing sins, you can put yourself in a much better position to achieve your investment goals. You'll have a clearer idea of what you're doing, and you'll be able to make more informed and confident decisions. You'll also be less likely to get caught up in the emotional roller coaster that is so common in investing. If you like this video, please do subscribe and leave us a like or a comment. See you next time on Money by Sunny.